The market is looking past any of these potential tariff policy implications for now. What does this policy do to the current bull market that we're in when it is implemented?
Well, good morning. The market obviously has a lot of cross currents right now. We don't really know how much of these tariffs or threats of tariffs are going to stick. In the meantime, earnings are very, very robust in the U.S. The economy is quite resilient. There's a lot of optimism right now about the length and strength of the economic rebound that happened since COVID. And so I think that right now is overriding the threat of tariffs, either raising in price levels or decreasing profit margins, because they would have to get worked through on one way or the other. And of course, the question of how much of these tariffs would be offset by a stronger dollar. And then on the other side, we have, of course, a very big debt situation, ongoing deficits. What does that do to the 10-year Treasury yield, which is right now at 4.5? Every time it starts to creep up towards 5, the stock market starts to wobble, and that's for very good reason, because Treasuries are considered the risk-free asset. And if the risk-free asset goes up in value or down in price or in valuation, it starts to compete with the risky asset. And towards 5%, that's been the case. But now we have, of course, the government efficiency, momentum underway. Again, we don't really know how much of that will stick, but that's providing some hope on the Treasury side. So all in all, the tariff question is really just one of multiple questions facing the market. And of course, we have the valuation question, we have the Mag 7 concentration. And I think for now, the market is focusing on earnings, and it's focusing on the 10-year Treasury being more better behaved in the face of the hope for less government spending.
Ed, what are you thinking about tariff and the impact?
Yeah, I mean, for me, the highest conviction view around tariffs is that they're negative for growth. They are ultimately a tax. They're a tax on spending. They're a tax on capital investment. And that is the first order effect that I'm looking for. I think secondary to that is inflation. It does cause a sort of a one-off, a temporary increase in prices. But I think from a market perspective, we're very used to, at this point, relatively elevated growth, and tariffs are likely to challenge that assumption.
And how are you thinking about the different growth impacts for different types of tariffs? There's the tariffs on something like aluminum versus the tariffs on finished products. Does it matter what the difference is in terms of the inflationary impact?
Yeah, I'll be honest, I don't know how to figure it out. There's so many different flavors.
That's important, because the market also doesn't know how to figure it out. If you can't figure it out, neither can investors.
I think that's right. And one way to look at it is what is going on in aggregate in terms of the aggregate tariff or tax rate that we're applying to our imports, offset slightly with dollar strength. And the net impact so far, we have had an increase in tariffs on metals, on China. The net impact so far is de minimis. The economy has not really felt it. But as the conversation heats up and eventually crystallizes into more tariffs, I expect to see that impact in growth first, and then we will start to think about what that means for risk markets.
And Jurrien, let's talk to you specifically about that. What does happen to risk markets in this environment? Specifically, let's actually broaden and go to the global context here, because we've seen global stocks outperforming the S&P year to date. Is that a dynamic you expect to continue given the potential tariff impact?
So my main focus is the juxtaposition of how much of the bull market is driven by earnings. And of course, at the end of the day, over very long periods of history, earnings are the driver for stock prices. But oftentimes you will get that earnings gain amplified by increases in valuation. And so 2023, the first year of the current cyclical bull market, and 2024, both saw valuations really amplify, right? So in 2023, earnings fell 3%, but the market went up over 20%. That was all PE driven. In 2024, the market was up, more than 20%. About a third of that came from earnings. The rest came from valuation. So for me, the question is, can the market do a three-peat on having both earnings and valuation drive the train? And to me, I think it's very unlikely that that will happen. I think the earnings side is very robust. Fourth quarter earnings are underway. They're growing at 13% year over year. The outlook for 25 and 6 and even 7 remains robust as well. The typical earnings cycle lasts, 3+ years. We're only in the beginning of the second year. So I think we have room there. But as rates start to creep up, and again, that risk-free asset going to 4.5, maybe to 5, that should undermine the PE side. And then, of course, we run the risk that if the air ever comes out of the Mag 7, with the Mag 7 being a third of the market and trading at 40 times earnings, right, it's likely that the whole market would be under pressure, and that would be a scenario where actually the rest of the world can do better, at least on a relative basis, maybe not on an absolute basis.
Something else that's impacting the Mag 7 trade in the broader market is, of course, some of those other macro factors we haven't talked about, like the Federal Reserve. Ed, talk to me about those macro factors and what the monetary policy could potentially look like in terms of impacting the trade.
Yeah, I think the good news for investors is, at the moment, if you're looking at the Fed, you're very likely to see them stay on hold through the summer. So at least among all the moving pieces we have right now, it's a really decent assumption to look at the Fed and expect them to stay on hold. Now, beyond that, I think it gets really interesting. There are two tail risks around this in this environment. One is the economy overheats. We have some negative supply side effects playing through, immigration, tariffs, and positive demand in the form of maybe perhaps additional spending, tax cut changes. If they combine in such a way that the economy heats up, similar to what we saw in 2017, 2018, then the Fed will have to consider hikes. Yeah. On the other side, if tariffs are a drag on growth, as I expect them to be, if inflation continues to be relatively well behaved, we'll return to the cutting cycle. And the bet you're placing on the second half of the year is really which side do you think things will skew towards?
Right, and it's interesting to kind of monitor the moves in the 10-year and what the rates market is trying to tell us about what that might look like. Unfortunately, we have to leave it here, guys. So thank you both so much for joining me on our special coverage this morning of these reciprocal tariffs. Ed Al-Husseini and Jurrien Timmer, thanks so much.